As the name would suggest, the TAMIM Global Equity High Conviction Fund is a portfolio of 20 to 25 names that have been carefully selected from the major listed global equity markets to provide a risk and return balanced portfolio for our investors. Our recent performance has been strong. We identified the need to be invested in companies with strong cash flow at reasonable valuations. And more interestingly, we believe that the market is now looking to turn towards a focus on more value and cyclical companies. Ordinarily, we'd focus on the process and stocks to the exclusion of any consideration of so-called macroeconomic factors, but we live in a very interesting time at the moment where we've identified three concurrent trends or themes that are happening to destabilize global capital markets, and they've been responsible for increasing the volatility of equity market indices and stocks that we currently see. The first of these, of course, is the referendum in the UK on June the 23rd, where eligible citizens get the chance to vote to remain in the EU or to leave the EU. This is commonly known as Brexit or Remain. The best outcome, we think, will be a Remain, but a narrow vote to remain, because it's pretty clear that EU economic policies are not working. Youth unemployment is too high, companies are not undergoing strategic and structural change sufficiently fast enough, and the unsustainability between the northern European countries and the southern ones is something that is going to put enormous strain upon the euro as a single block currency. We've positioned the portfolio to be, as best we can, immune from the shock of a Brexit. We favour companies in the UK that are multinational companies. They do business outside the UK, and they offer a chance to invest not only in the prospects for European growth, but also from the USA and indeed China as well. The second current major trend or theme that's worrying capital markets is, of course, the US election, which is due in November. The two candidates, Donald Trump and Hillary Clinton, are clearly from opposite ends of the spectrum, and we don't expect this to be a clean and fair contest. Our expectation is that Hillary Clinton will prevail, and global capital markets will like that because she will be seen as a safe pair of hands. However, Donald Trump makes some very good points, and income and asset inequality in the USA has not been helped by multiple years of zero interest rate policy or quantitative easing. We haven't been fans of that policy. We are not fans of that policy, by the way, in Europe. And we think it's better that the Federal Reserve raises interest rates at some point in the near future, and the USA can begin to address what are some serious concerns on income and asset ownership inequality. I was in the USA recently, and there is real frustration that the wage growth has been negative or zero at best in the last 20 years. There's real frustration at the lack of investment in public infrastructure. Roads, bridges, schools were all part of the Barack Obama manifesto, and the US capital expenditure is just not happening as companies are very scared to invest in the face of zero interest rates and possibly negative interest rates being imposed. We think that zero interest rate policy has to stop. The third major trend or theme that's worrying markets at the moment is the trajectory of the Chinese economy. We think it inevitable that the Chinese economy will slow. These things tend to happen as countries get richer, growth rates tend to fall. As countries tend to get more service-oriented, growth rates tend to fall. It doesn't mean that China is not going to contribute to global growth. 10 years ago, the Chinese economy was about half the size it is now. So a 6% growth rate for China going forward is equivalent to a 12% growth rate for China 10 years ago. We'd have been very happy with that, and we therefore should be happy with the 6% growth rate for China. The main issue appears to be the level of debt that's outstanding owned by state-owned companies in China, but these debts are owed to state-owned Chinese banks, and the problem is consequently self-contained within China. It's unlikely that bad debt provisions, which will have to go up, are going to trigger a major cataclysmic effect on the global banking system. That's how we position the portfolio anyway. We like certain global multinational companies because they are benefiting from what is still reasonable top-line growth in China as the 1 to 1.5 billion people enter the global middle class. In terms of the portfolio, we like very much to focus upon stocks, and we use a combination of quantitative models which help identify stocks which are unloved and overlooked but with improving fundamentals. Combine that with our experienced and fundamental forward-looking judgment, and we like to call our quantitative model a V for value, M for momentum, and Q for quality, or a VMQ model. And we combine that with careful analysis of the accounting and strategic positioning of companies. The 25 companies that we own are carefully selected to provide a representation of sectoral and regional exposure, so we don't put all our eggs, or all your eggs, in one basket. Most recently, we've been moving money away from the USA. That equity market looks tired. The economy looks to have achieved a reasonable amount of economic growth. And as I say, I think that an end to zero interest rates might be a short-term shock to equity valuations. We've begun to focus more of the portfolio onto European names, where we think that there is too much risk and too much fear and panic priced into equities, which are trading sometimes below book value. We also think the Brexit vote is going to serve as a wake-up call to the elites to change fiscal policy, particularly where much-needed transfers from the rich countries to the southern countries are needed, as well as some debt write-offs and debt forgiveness. So we find a lot of value in Europe, and we think the catalyst for that change to recognise the value is going to come from the Brexit vote, or indeed from a number of elections that are due this year later in Europe. So the portfolio has been getting more value-y, and to give you an idea of how attractive we think that is, in a world where 10%, I beg your pardon, 30% of the world's sovereign bond markets are yielding zero or negative rates, our portfolio is trading on a modestly low teens PE multiple and has a dividend yield of just under 4%. So whilst we're not arguing that you should put all your money into global equities, there certainly should be room for some of your money to go into global equities to diversify away from the so-called safety of sovereign bonds, as well as the Australian equity market, which fundamentally is too reliant upon finance and resource stocks.